than expected. But hey, we're going to talk inflation, bonds, et cetera, today, and we're going to take your trades in an extended TheoTrade live session. How we doing, Blake?
You know what? I'm feeling the glooms already. It seems like that volume has just missed and missed, and I'm having a hard time getting excited about the market here. Uh, it's I like directional breakouts, but I did we hit the sell in May and go away already?
Yeah,
That's what I'm worried about.
yeah, right. I'm like, we've done nothing in May for all intents and purposes. We're hitting summer. I mean, earnings, is it a really big driver? I mean, certainly for some stocks like Nvidia, I mean, you've got those big short squeezes and like Gap this morning. We had that previously in Abercrombie and Fitch. We should have let off with the song, right? Of
Oh, we should have. We
course,
should
when
have had.
we're pushing 50, it's like, should we really talk about girls wearing Abercrombie and Fitch? Probably not. So
Pushing 50. I already crossed. Sorry,
I know I'm going to
I've
cross it
crossed
later this
over.
year. You just recently crossed over.
I did in February. Yep.
Yeah.
It's not over the hill. It's actually we picked up the pace. So it's
But
definitely in a downward turn. Yeah, and you can't really talk Abercrombie Finch without talking Lululemon. I know there's a lot of things that people look at there. Did you ever see It's a Mad, Mad, Mad World? Do you remember that?
uh
Is
yes,
anyone
I
here old
remember the
enough?
movie. Like I do not remember it all. It's been a long time.
It's excellent. What's his name? Terry. Oh, I can't remember the English guy's name. He's the one that was Sir Hith, and
Uh-huh.
he gives this tirade about the U.S. economy being attached to the brassiere. And so I think that's all we've done is we've tied that back into yoga pants now instead of Lululemon or instead of the brassiere, it's Lululemon yoga pants. The entire U.S.
Yeah.
economy is dependent upon yoga pants. And we'll look at all that. We got a lot of extra time today because it's extended one. We have
Yeah.
an opportunity to look at a lot more of your trades. So as we're going along, as we're talking, hang on to those. We are going to get to those. We're going to do a whole bunch of trade questions that you might have. We can look at the charts together. We can talk about it from fundamentals and technicals and all that. But I think we got to lead out with inflation. That is
Yeah.
the core. It is what is driving the world. We can see that we had inflation come in with the Eurozone and the US today. Core CPI out of the Eurozone year over year and flash estimate, as well as the PCE core. Now, what does this mean to you, Brandon?
Well, I think we saw, this past week in the commodity market. I mean, the dollar had a big impact on gold, for example, other commodities. And again, part of that picture is what, depending on what the Fed's going to do on interest rates. And of course, PCE is the Fed's preferred measure of inflation. Those are personal consumption expenditures. And at 0.2%, are they going to get on the boat and yell mission accomplished? Or are we going to say, look, I mean, the risks still remain. We'll see if it moves the market today in terms of bonds and interest rate expectations. But right now, I think this week we're coming to the realization that inflation's a bit sticky despite the PCE here. And we may be poised to rise unless we start to see much slower economic growth. But I think when you see the Eurozone PMI or CPI rather coming in hotter than expected, I mean, a lot of them expected we're going to ease, we're going to cut rates. They're potentially in a recession at the moment. I'm not sure that I'm not sure we're really going to get the all clear on inflation for a while. And I think the Fed minutes last week kind of showed that as well, that some are leaning towards raising rates.
Yeah, and it to me, this little bounce is one bounce enough. It could be. I mean, that's that's kind of all we've got. As soon as you see any upturn in this, the
Yeah.
Eurozone, who is saying, "Hey, we're broke. We got to
Yeah.
cut rates. We got to cut rates," and all of a sudden inflation kicks back in, even though it's only a little bit of an increase. It's a year over year increase. It's the core and the top line, and that to me, that we're seeing it in both, that uptick in both is a threat. And I think
Yeah.
that maybe, and I could be wrong, I would imagine that J Powell and others are watching this too and saying, if we're not careful, this is us.
Yeah. Well,
And so go ahead.
yeah, I mean, after their last meeting, right? I mean, if we take a look at the 10-year, for example, again, they got dovish, right? okay, hey, we're going to cut two times this year is being priced into the futures market. And then all of a sudden, what happens? This past week, we're seeing the reversal in the bond market. I mean, and we're back to where we started. And so, I mean, this is a problem, right? They don't have a clue, right? They've never predicted a recession before it comes. They've never been ahead of it, right? Anything we suggest to say that the Federal Reserve is capable of understanding where interest rates should be, where inflation's going, where the growth of the economy is, and where we should put productive what type of assets we should be investing in. They don't have a clue, right? They're 12 people, sitting in the dark, trying to act like they know, and they don't. And again, so we have to understand they're not all powerful, and
Tell me
so
how you really feel, Brandon.
yeah, right. Hey, they said we can whack the Fed, right? But on the production side, but I mean, this is the thing: is that we can try to put faith into these planners. The reality is, they don't know, and they've broken the rules that supposedly they apply throughout this process in the last number of years. And so again, where what are they going to do? I think the market's really right now questioning, and we talk about selling may go away. It kind of comes back to that, right? Are we starting to question the Fed and their ability to really create growth? And is the inability of the Fed, even if they lower rates, going to cause a sufficient rise in prices? They're going to have to turn in reverse. And I think maybe the market's starting to get onto that a little bit, where it's not just, hey, the Fed's going to cut rates, let's buy.
Well, and the idea that they're going to cut rates, where we just the other day saying they're leaving them alone and we're going to possibly see a rate hike. And so the market is struggling with this, I think, more than previously. And when we were looking at this, I think you can see it in the price action. We saw downturn, downtrend, downtrend. We tried to break out. We broke out of this consolidation. We dropped right back in, and here we are, dead center in the same consolidation
Yeah.
after a huge swing up, swing down, and we've gone dead center. And be aware, everybody, this is the ZN. It's the bond futures. They're open, they're live, they're moving. And so this reaction pushing us back center, not up, not down, just back center, is the response to this lighter inflation number, the slowing of the inflation number. And
Yeah.
so to me, that is a vote of non-confidence. That is, I don't believe you know what you're doing. I don't think I know what you're doing. And so how can I plan? How can I prepare? We got to bring it right back to center until I get a better clue, a better hint of what is
Yeah.
going to go on. And if we look at the CME Fed Watch tool, this is out to December. You can see this is our current rate. We have 40, 32, 10. We'll add those last two. And so we have 85% probability of another rate cut, at least based off the CME. 16% of it staying the same. And this has gone down a little bit. We were up about at 1% of a rate hike. I mean, nothing big.
Yeah.
But its reality is we're shifting back into that rate cut with
Yeah.
the movement today. So
Yeah. And we're still, greater than 56% chance of being a quarter point or higher. I mean, sorry, a quarter point or less in terms of a
yeah,
cut. But again, I think this is the point: is that if the Fed funds rate's 5.25 to 5.5%, the 10-year right now is at about 4.5%. So on the news, we probably are seeing some buying in the Treasury market at the moment. Say, oh, all clear for the moment. Yeah, we're definitely seeing a downward movement in yields right now, upward on price. But you figure, you're probably about 1 to 1.25% on the downside in terms of yield. So for 5.25, 5.5%, okay, maybe we can stretch lower to about 4% on the downside if the Fed's maybe going to do a quarter point cut this year. So I think right now we're just in this range between 3.8% and 5%. And depending on where we go from here, and again, certainly today, buying in the bond market since that inflation print came out, but I'm not sure we're going to get down to the lows quickly until we kind of figure this out. And unfortunately, and it's probably going to take the Fed to really point to a cut. Probably going to have to see more economic slowing, because again, when the last Fed meeting, it led to what? Buying in a short squeeze in the Treasury bond market. So I'd assume we're probably fairly neutral on that front right now. It led to a little bit of a push in the stock market, but guess what? Gold outperformed the S&P 500 since the Fed's meeting in April. So, I mean, we're not necessarily getting real growth out of this. it's really just dollar weakness at times pushing the market higher and underperforming gold. So I've been kind of telling, my sessions, look, if you're bullish on the market, you think the Fed's going to cut rates, guess what? You probably want to be long gold over the S&P. And since the first week of March, been talking about being long utilities over the S&P 500 just based on that relative strength relationship. And that's been a great trend in utilities over what the market's produced, over the S&P's produced. I mean, it's been a phenomenal move in the utilities market. I know that's an area you've been bullish in as well.
Yeah, they've definitely been bullish in the utility market, and we're going to get into a little more detail and tie it to energy here in a minute. Something I covered in yesterday's video. But going back to your gold comments, gold being a safety is one thing. Gold being a aggressive growth move here, 10,
Yeah.
15%, that that should scare you. Not maybe scare Brandon, but scares some of us. This flight is not just a safety. That is a massive rally in gold price, and
Mhm.
we've held here. We did that and we accomplished that in less than a month, really.
Yeah.
And so holding there up at the top, and Brandon, Brandon had some things that what made it so that I had to fly solo last week,
I
and
know.
and I
I could
I
see
was
only see
sad.
out of one eye and my no, but man, it's like my Falcon's coming, right?
Yeah,
So our
well,
TheoTrade members, and we refer people to Falcon trading systems, or they build computers, and so mine's on the way. So my MacBook, it's doing okay today. It
Well,
is
I
not.
was going to I told you we were going to do last week when you still had your eye look a lot better than does now. I mean, now it's less exciting.
Yeah,
We
I
were going
know.
to do talk like a pirate.
I
I gave
know.
you a temporary private temporary pirate membership card, and you throw it away. Couldn't join
I
me,
know.
but I thought, what a great time to do it. Gold and pirating, and it's
I
going to
know.
be a great conversation
I
last
used
week.
to, I used to just, and it was nobody asked me to do it, but I used to write kind of an intermittent newsletter for, it's one thing when you're working in an environment, you send emails, but it was called the Pirate's Guide to Investing.
Oh,
But
sweet.
yeah, I don't think anybody read it, but it's just sending it to my fellow coworkers and just trying to put my thoughts out there. But anyway,
Yeah,
but
my since I don't have an eye that doesn't function, my uncle's had uh, multiple eye surgeries like I have, and so maybe it's genetic. Who knows? But because of that, we've been telling each other pirate jokes for the last 15 years. So
you probably got some
so
good
we
ones.
oh there's we do, but some of them are not shareable here.
Oh, okay.
So let's get back to the conversation.
They're, they're going to change our rating,
That's
but
right. We're
but
gonna
so
YouTube's gonna tag us as an adult
adult content,
content
it's
because we
sensitive.
told pirate jokes. So
Well, they're probably going to do it anyway because I went off on the Fed a little bit. So,
yeah, it's
but
true. So when we're looking at the inflation data and going off on the Fed being what it is, the question is gold going to stay in this holding pattern? In my view, is this hedge? Are we balanced to this point where PCE is maybe pulling back a little bit? Do we need the hedge here? Where's the rotation next? And are we going to rotate before the end of the summer? That's one of the big questions I'm trying to decide is, am I going to sit here and scalp out pennies on the gold futures because I can't get a trend anymore?
yeah,
Um, and I'm not sure where inflation's rising in the Eurozone and falling in the US, a little slowing in the US, because gold is an international hedge. And so I think we got to look at gold as a little bit bigger picture, a little bit step back from the TV screen so that we can actually see and say, this is not just representing weakness in the dollar. We can see flight to gold, and gold holding here can
hmm
actually be gold rising in others while the dollar is maintaining its strength. And if we look at the dollar, ignoring today's and yesterday's sell-off, the dollar ran up, pulled back aggressive, and this is in the super consolidated pattern the way I see it from a very, very long term, but slightly stronger than weaker. And so this pullback, if we break through these lows at 104, that's a lot of weakness for the dollar. And I think that the flight to safety is away from the US dollar and probably back into gold, probably back into other instruments. And it's all going to be back to the bonds. Are we going to see higher yields, higher costs, or not?
yeah, yeah. And there's the last couple weeks there was someone in chat, oh, I don't see any evidence for inflation. I'm like, okay, I get it. You're like looking at the number is lower than it was previously, but the price level is not declining. It's just going up less quickly. So,
Right. And
I
that's
mean,
what I was
it's
trying to remind you. We went at 90 miles an hour. Now we're going at 70 miles an hour.
right.
That doesn't mean we're not going fast.
And we can, and the thing is, like, with that, I mean, the consumers are still paying very, very high prices. I'm going to give a little bit of anecdotal. Just driving to California this past week and driving around California, we went to the Angels Yankees game, in which there was more Yankees fans there than Angels fans. I mean, they're cheering for the Yankees and it's loud. But the point is, I'm like driving down here for the first time in a really long time, years, the least amount of traffic I've seen in Memorial Day weekend. This is last week. And driving around, I mean, the amount of traffic down here is way less. Why am I saying this? It's a function of saying, look, prices have gone up dramatically for a really long time. And so as a function, consumers are still stretched right now. And we could look at gap earnings. We can see ANF. Those are high short interest stocks. Those are those stocks that have a short squeeze potential. So a beat can really cause a pop in them. Gap's going to open up on a major gap today. And again, is that a lasting influence? Is that a reflection of a solid, sound consumer? If you look at Kohl's, KSS, I mean, this is not exactly the type of economy that an economy that's driven by spending and debt, et cetera, that's necessarily on great footing. It's just, hey, if you can eke out a little beat and you've got nearly 20% of your float shorted, yes, you're going to go up in the case of ANF and Gap, but then you see Kohl's. So again, Target has had some issues, but then Walmart went up. So it's one of those things where the consumer is not necessarily in great footing. Gas prices at 4.5 to I've probably paid almost $6 while I've been down here in California. It's like, I mean, that's a major problem. And so again, I mean, we're seeing the consumer, certainly evidenced by Tyson, what they said. They're selling chicken nuggets. I mean, what gets more basic than that? Warning
Oh,
about the
I
consumer.
hate the Colonel. His wee bitty eyes.
It's like an orange on top of a toothpick.
I
But
hate the
was
Colonel
that
with his wee bitty eyes. If he puts addictive chemicals in it, so you crave it Fortnite. So Tyson, Tyson's pulling back here that was interesting to me because this is a substitute stock, and I think when you were looking at Lulu, we're looking at Target, we're looking at Kroger's, we're looking at KSS, we're looking at all these. It seems to me like we're seeing a little bit of substitution going on there, and the substitution is a way we hide inflation quite a bit. And to me, it's interesting to see Tyson sell off because I think Tyson is a substitute stock. It's an idea that I'm not going to buy steak, I'm not going to buy a hamburger, I'm going to buy chicken because I can get that for $2 a pound, or even $1 a pound if I'm buying drumsticks, versus buying $5-6 beef, or the new Wagyu beef at Costco for $8.50 a pound. So,
is it worth it? I
but
don't know.
it's just that substitution effect, and I was a little surprised to see that chicken was pulling back at this level, because there is a substitution effect. Like you're saying, we're not going on trips. We're staying local. You're not flooding California right now with out of state cars rushing to Disney. And I do think it's the consumer is getting worn out, and there's only so much more substitution we can do before we start seeing elimination instead of substitution. And so that's why I should have put this in my list, but I'm still looking at things like Jet and Marriott as continuing downtrends. And
Yeah.
really, we could do Carnival Cruise and
Well,
other things like
right.
that.
And
As
Carnival and Norwegian, I mean, those are two of the higher beta stocks in the S&P 500. So sometimes you get that high beta kind of push, and they tend to benefit even though the fundamentals may not be there. But you look at American Airlines, AAL, on the airline front,
woof, I have not looked at them.
yeah, right. And now you saw yesterday there was some oh no, sorry, it's yeah, no, it was on Wednesday. There was some bullish option activity in Delta and Love, Southwest, bearish option activity in American Airlines, but I ain't buying it. I'm like, if American's struggling like that, I mean, really, any push higher we get here, yeah, we're seeing that kind of bounce
Well,
you're
but
probably more
it hasn't
looking
even
at
filled the
an
gap.
opportunity to get short again.
Yeah,
Yeah, right. We're just
bail at
filling
the
the gap.
gap and short it.
Right. So, I mean, so sometimes you'll see the options market, they'll start to bid these stocks or buy calls on these stocks, and you get that positive feedback loop. They buy thousands of calls, then all of a sudden you see the option maker has to sell thousands of calls, and then they've got to buy stock to try to hedge their position, and you get this kind of feedback loop. And then if you have some short interest, the shorts get squeezed a little bit, you get a push higher, and then we start the process over again. And that's what we're seeing here is that these just provide another opportunity shortly to get back on the bearish side of it. And the nice thing is for most of these stocks is that it's really easy to buy put spreads because the skew is the put side is you're able to buy the lower volatility and sell the higher volatility, buy the higher strike and sell the lower strike. And so this is kind of a reset opportunity. If you missed the initial downdraft, we're now kind of climbing our way back up again, looking for that to roll over. And obviously oil prices will have an effect. But if we're talking about overall just consumers being strapped, jets would be an example of an area that you'd probably expect to roll over off
Yeah, and
of
it's got a
off
lot
of the
further to
bounce.
go. It's got a lot further
Absolutely.
to go before it fills that gap. And so I agree. That's why I said I should have made that. That should have made my list. Um,
I know. It's like how many stocks can we put on? It's one of those
oh,
things.
we kept adding to it. We kept adding to it, and this let's do this one, let's do this one, and it kept growing, and so we
Yeah,
had to cut it off at some point. But hey, it's an extended session, so guess what? You get it all. You
that's
get a
right.
stock, and you get a stock, and you get a stock. So we'll get to that here in a minute. But
I
when you're talking
want it
about
all.
when you're
It's like
talking about
Queen. I want
crude,
it all. Sorry, go ahead.
oh, it's excellent. We definitely like Freddie. Um, crude, it's interesting to me with the idea that we've pushed higher and higher and higher, and retail gas prices have pulled back off the high. Crude is selling off. Now, selling off here, I don't know if I'd really count this gap here that, we have probably some
Contract.
contract changes that are happening here that made it not calculate properly. So I'm just looking at this downtrend and a minor bounce in retail gas prices. And I'll repeat, everybody, if you're if you're kind of planning a budget at all, which a lot of people don't anymore, but if you're looking at a budget at all, if you're looking at retail gas prices, you can stop at your gas station and look at the pump, and some of them will list their federal and state taxes right on the pump. And if it does, simply add that to this number, 242, and that's going to give you an idea of what you should be paying. And higher than that is extra margin for your local gas station. But overall, this little downtrend here, how far does it have to go before consumers feel relief? Because right now, as Brandon, anecdotally commented on, we're not seeing it enough to change our summer trips. Memorial Day weekend, supposed to be the highest demand weekend of the year, and yet crude's in a downturn. Crude is down below these lows. We sold off yesterday and closed at the lower prices below this consolidation. A little bit of bounce in the morning here, but crude and retail gas prices are in a little bit of a downtrend.
Yeah.
There's an anchor to pulling it back down through here, and I think that's a demand anchor. We're seeing demand slide.
Yeah, so Blake Jean's asking, he says, Jeff Bierman says to go overweight on oil stocks, but I hear you correctly in your nightly video saying oil prices will go down. We may have a little conflict here, Blake. I'm
Well,
taking the other side of this.
it might be, you might think there's a little conflict in here, but that would be, you can either agree with me or you can be wrong. So as we're the here's a little interesting aspect of it. When we see the downtrend here, I mean, can you argue this is not a downtrend? Let's start with that.
Well,
Um,
I would see. I'm going to say like I look at the most recent little pattern here, and this is the quandary that we have in the market, right? In May, we've virtually done nothing. We're kind of sitting in this holding pattern. Oil sitting in this holding pattern. I look at the market in terms of the futures contracts. We're still in backwardation with falling prices into the future. There's still an implied shortage, and so I look at the fall in gasoline and oil prices holding. I probably look more bearish stuff like VLO, for example, that's
mhm.
refiner. Yeah, so if you look at CL, you'll still see that if once that loads. see prices are kind of falling as we move into the future. It's flattened a little bit though, right? But we're still in backwardation from my perspective, still showing risk to the upside. But everything hinges on what can the consumer bear? I mean, if all of a sudden OPEC, I mean, Blake, you mentioned OPEC before we started when we're talking. If you look at OPEC, there is a tendency if oil prices start to get a little soft that they start to cheat, right? And what that means is they step in and start to pump more, or sorry, start to drill more than they had agreed upon, and we start
Mhm.
to see weakness. Now, it hasn't necessarily fully materialized in the future's term structure because prices are falling in the future. There's still a net positive cost of carry. So I've been more bullish on producers and integrated names. MRO by the proposed buyout by ConocoPhillips this week of MRO has certainly popped that stock. But one thing I found is that as MRO was going up, sometimes when you start to see consolidation in the energy space, it has kind of a sympathetic lift for a lot of companies, and it didn't do it this time. So the big gap up in MRO did not produce a subsequent lift in the entire space, saying, hey, we're going to start to consolidate. There's going to be more buyouts. If you look at XLE generally, it didn't necessarily get that lift. In fact, we sold off the other day. So
So you agree
it's
with me?
so I'm agreeing but disagreeing. No, I'm saying what I'm agreeing on is saying that we're at a key level right now, right? The term structure says oil prices are going higher, but all of a sudden, what you're seeing is that that did not get any lift with MRO. And again, if OPEC starts to cheat a little bit, I mean, man, prices could come down if we start to see
When,
real demand
when,
fall.
when they
When
start to cheat, they always do.
they all well, that's the thing. A cartel, I mean, never,
There's no
but
honor among thieves. I mean, that's kind
right,
of what we're dealing with, right?
yeah. So I mean that's the slippery slope. I mean, it's all a function of what is the Fed going to do? What is the outlook for the economy? If all of a sudden we think the economy is okay, the Fed's going to cut rates, oil commodity prices are going to go up. But if we start to price in a recession and we start to see real demand start to wane, OPEC gets nervous, they start to cheat, oil prices could come down fast. So I think right now we're kind of in that wait and see mode, just like with gold is going to break out. Yes, if the dollar weakens, but if the dollar doesn't, then we start to see some weakness economically globally. We start to see more demand for dollars. This is going to, and this is where the market stands. So I think we're really at kind of a moment right now where the market's really got to sort things out. And I think ideally we need to go down a little bit before we're going to be able to go up. But again, we've got Powell out there. He may try to goose us again.
Yeah, and
Goose the
I just
Bears.
I just still think that we saw the break. I mean, Valero is one of my favorite examples of what that break that
Yeah.
and you mentioned it as well. I mean, we cleared that low with energy. We slammed
Yeah.
into it and followed through. We've broke through any type of support. We've got lower highs, lower lows. Crude has been on the downturn. And one of the things I shared in yesterday's video is that the OPEC is estimated to have the capacity to have or produce 4 million barrels excess supply, excess over its 2013 to 2023 average, uh, all the way through 2025. And so, or 2026. So for the next rest of this year and the next 2 years. And so we're seeing the pressures definitely to the downside in the short term. And we were down here not that long ago. And has the economy and demand increased where we can justify them moving higher? And I think, like I said, I think they cheat. They will stab each other and move over to production, full production. And I think we will push this higher and higher and higher. And I don't think in an election year you're going to have an administration wants to see oil prices move off of this low either. And so I just think you're going to still see the pressure to the downside. And if we do see oil falling, then natural gas should be falling. And if natural gas and oil are falling, this one hasn't broke yet, then the utilities are going to do well. That's
Well,
why
and
I
that
put it as my list.
there we go. Earnings. Yeah. So I mean, with natural gas, I mean, a lot hinges on oil production. So
Yep.
if oil production increases, there's going to be more nat gas produced. And the reality is, for a lot of these energy companies, they don't have a tremendous amount of cash. They do have a lot of debt. So normally, a company you think of oil prices go down, they should produce less. But because of the debt, they act a lot like governments in terms of how they manage oil supplies, like a Venezuela or other countries that can do it, of Saudi Arabia. If oil prices go down, they produce more because they have this, they have to service their population. Whereas, oil companies have to service their debt, they're low cash companies. And so as a function, they tend to produce more as oil prices start to come down. And that exacerbates the oil surplus, which ultimately you produce more oil, you also produce more natural gas. So this might be a tenuous perch right now in natural gas. And if oil production ramps up a little bit, gas prices, natural gas in this case, should go down. But VLO right now is buying oil, converting it to refined products. And so the fact that oil's held, gas prices are falling, that's producing additional pressure on refining companies. So if there's an area to short energy right now, that's probably the place to look at the most.
Yeah, and I'm going to pull back one more before I go back to Valero for you. Is when we're talking about natural gas falling, please be aware if OPEC produces, natural gas does not necessarily fall.
No, it's U.S.
It has to be U.S. because transportation of natural gas is very difficult. We can do LPG and other things like that, but to get the compressed natural gas into a liquid state so you can ship is extra cost. And so it's when crude is produced at the domestic level, that's when you're going to see natural gas collapse. And that's what we're not seeing yet. This is more being driven by the global view and global aspect. I mean, we could take a look at WTI. What is it? What is WTI? Is it
WTI is a stock, but
West Texas.
I forget this one.
Yeah, I can't. Okay, it's okay. I was going to try to look at U.S. production, but
yeah.
Joyce is asking what kind of time frame I'm looking at. I'm just looking at that. If we can clear this low in the next week, then we come back down to 70. That's it. So by next week, if we clear 76, I think we're going all the way back to 70. And that would probably be end of July. So maybe a 2-month time period to come back and test 70. I'm talking about a 10% correction in oil if we can break through 76 in the next week.
Yeah, my session Wednesday, I spent a bit of time on oil and talking about this term structure and all that. But again, everything hinges on if you're going bullish oil here, you probably got to be bearish on the dollar, right? I mean, so that's going to be a driver. Grumpy Mike saying on YouTube, he's like, he says they can produce more oil if they want to. Why would they? Consolidation among oil companies will just make it worse. So yeah, consolidation among oil companies means what? They may cut production. But remember though, why do they produce more? It's because if you have a certain amount of revenue you require, let's say you're Saudi Arabia, right? Can you afford prices to go down and have less money come into the coffers? We've seen, the Arab Spring or what it was, a number of years ago. I mean, spurred on by higher costs, less subsidies. And so the reality is when you're a cartel, you're basically assuming, hey, we're agreeing to try to keep oil prices up. But once there's a conviction that oil prices are going to start to go down, you're trying to get while the getting's good. And that's why cartels break apart as prices start to get battered as a result of demand falling. They're trying to get as good a price as they can get. They're trying to get as much money as they can in the moment. And that's why cartels don't work if the oil market starts to loosen up a little bit. And again, there isn't necessarily direct evidence of that necessarily, in terms of the oil market. We're just seeing weakness, from my perspective, a lot to do with the dollar, but the outlook is uncertain right now. And that's what the market's dealing with. And again, just looking at the fact we didn't get any lift among other companies like an APA or other ones with that MRO announcement, ConocoCOP potentially buying them out.
Yeah, that's the other one I liked is a bearish one is COP.
Yeah, I mean, and you can kind of understand with COP because they're spending money, maybe shares of stock. I don't know what the terms of the deal was. So sometimes it makes sense for the acquiring company to go down and the acquired company to go up. But oftentimes you see kind of a carryover saying, well, hey, if they're buying MRO, who else are they going to buy? We didn't get any of that lift. It was just more just general weakness with the exception of MRO on that announcement. So that's again, it just didn't create a lot of excitement in the energy space. Like I said, there was some long call activity on XLE, buying an out of the money call spread on it. And from my perspective, with energy companies, the rising ball structure on the call side, those out of the money call verticals are relatively cheap. The put verticals, because you have rising put implied volatility, generally speaking, are reasonably priced as well. You can take a very defined risk approach to trading these stocks and just kind of taking that directional stand for like 50 days. If it goes up, great. If it goes down, great, depending which way you want to go. But right now, I think we're in that period where we're just trying to figure stuff out.
Yeah,
And
well, and we're also in that period where the market's about to open, so I can't look at a current implied volatility.
yeah,
Um,
it's getting
so
squashed.
I was hoping we would be able to see that. We don't have 0% implied volatility. Otherwise, you just buy
Yeah,
everything, buy out of the money strangles.
you
Um,
know,
so before we go into some of these other trades, we are about 7 minutes away from the market open. Uh, do we respond and react after the open now that we have PCE out? Are we going to see this disinflation slowing down of the inflation of 0.2 instead of 0.3? Is this going to give us the lift to erase yesterday? Are we going back up to 52.88? Pre-market, we've reversed. We tested the low on, I would say, on the Eurozone, and we've
mm,
recovered. And we could be erasing yesterday's though a small bearishness, at least as far as the S&P is concerned. We're
yeah,
already pricing that in.
yeah.
My question is the market taking this as a reason to have they been emboldened by the slowdown? Are we going to be looking at bonds back up again and equities up together, bonds and equities up together, pushing the dollar like you're talking about, dollar all the way back down? And are we going to go for another 52-week high?
Yeah, I look at that day on the 23rd, and obviously you have a little bit of a higher push because of the futures there. But to me, that range, especially in like the SPY, during the cash session, that to me is like very like significant. The fact we took out that low. Now, again, I'm not suggesting we can't break the low of that day, but if we do, it's significant. And then we're looking at the high of the day. And so the 23rd to me is a very big day. The low and the high, I think it defines the range over the last couple of weeks. So if we take out the high, that's going to mean bullishness. We're headed further to the upside, but be careful, right? Further to the upside means it's probably going to be labored depending on how weak the dollar gets. I mean, if the dollar really starts to sell off hardcore, gold really starts to ramp up, then yes, I mean, this may have a chance of making a bigger move. But if you look at skew, which is in the 150s at the moment, back month 90-day volatility recently is significant, well, almost 20% higher than 30-day volatility. There's a lot of measures that suggest that if you're going to be long, you probably have a lot of cash on the sidelines, is that we may grind it out, but the downside risks are only going to re-elevate again. And so again, it's reasonable to take some bullish plays. ITB is one that, again, if yields are going to fall, it's at support. We may get a bounce here.
Well, we already
You
got
know,
the bounce. I think we got the
we
bounce
got
yesterday.
yesterday,
That's
but
a
we
that's
we
a
we
candlestick pattern right there.
absolutely right. So it's what is that? Or the morning, wait, wait, wait. Morning. What is it called?
Morning Star.
Morning star. There we go. Uh, but yeah, we might push to 152. Right? I mean, if yields come down in, the dollar weakens, we may see a little bit of movement. So I'm generally bearish on home builders, bearish on real estate. And we kind of talked about as the prices were pushing a couple weeks ago to look for that opportunity to get short, and that opportunity was there. But right now, again, there may be a long opportunity in some of these interest rate sensitive areas in the very near term. The hard thing is that how do you go long down here? Again, there was some bullish option activity in ITB yesterday, buying the 14 June 104.50s in ITB. So again, people are kind of stepping in maybe in anticipation of maybe a weaker inflation print, lower yields on the 10-year, maybe short term kind of lifting these stocks. But again, it's a risky area because again, are you convinced that bond yields are going to continue to fall? And that's again, so you from a risk reward perspective, it's a pretty reasonable time, but the bigger picture is still it's up against it.
Yeah, and I would jump over here to the 60. For those that are watching the dollar index, one of the things you should understand is the dollar index is not the dollar's purchasing power against commodities or equities or anything else.
Mm,
It's the dollar against currencies. And so, and at 55% of it's this euro. So as I'm looking at this from this pre-open and focusing on this 5 day or 5 day 5 minutes, I want you to see what we've erased. This is euro weakness and dollar strength. And we did that from Tuesday's high to Wednesday's, well, Wednesday night, Thursday overnight. That low, huge sell off, dollar just crushing it. And since Thursday night, after the middle of the night with the Eurozones open and their econ, we've erased it all.
mm-hmm.
So 2 days down, 1 day up in essence. And that is, to me, that's a reversal. It's absolutely a reversal. The dollar is getting beat up. Now we've pushed right up here to the monkey bars. I see some conversation going on the side about volume profile. I use the monkey bars in a projective fashion instead of a developing fashion. So a lot of people use the volume profile as showing me what I have going on currently. I project the next time period based off previous time periods, a little bit different approach to it. But notice how perfectly it rejected the high, how perfectly it rejected the low. And so to me, we're probably done today with the euro gaining and the dollar losing. So we bounced off of this almost perfectly in the overnight, traded all the way to the top. We went end zone to end zone, distribution to distribution, and played almost perfectly the distribution. And so I'm looking for a top in here at 108.90. So I don't think the dollar is going to continue to lose, at least based off of how it's behaving pre-market. And this is after PCE and CPI. So we've already priced in everything. We've already reacted to everything. So I wouldn't be surprised to see a retest. But to me, the dollar may, this is the euro strength. So the dollar may be finding a base in the overnight right there while the euro is making its high. Is that
Yeah.
making sense to you as audience members? This euro is 55% of the dollar index, and they're inverse because the dollar's listed first here, the euro's listed first here.
Mm. Yeah, Eric's asking on the TheoTrade site, why do you think the dollar reversed? So again, think about it this way. We had inflation data, Eurozone, and we had US inflation. Eurozone inflation came out hotter than expected. US inflation came out lower than expected. And so you think from a policy standpoint, the euro, your ECB may be more likely to raise, and now the Federal Reserve may be less likely to raise. If interest rates are expected to be change more positively in Europe and less negatively in the United States, that creates what? Dollar selling, euro buying, at least in the very near term. In a crisis, there tends to be a lot of demand for dollars because there's a lot of US dollar denominated debt that tends to increase demand, kind of that reversal in the carry trade. But again, just based on today's inflation data, both in the Eurozone and the US, it would favor, in this case, the euro doing better than the dollar to an extent.
And I
But
would throw in there the idea, Eric, that the market, without getting into econ, both Brandon and I will have this tendency to geek out on economics. It's what we, spend our time in school doing it. And so to make it simple, the market always prices in everything it knows exactly at the current price with a discount for what it thinks is going to happen in the future. And so what they're saying is saying, hey, this is where we should be based off every data that we got on inflation. But we're still looking forward and saying if the Eurozone's going up, higher likelihood of rate hike, and therefore higher demand for deposits in the European banks because you get more interest rates. And a little bit of fade on the US because if we're pulling back, then we're not going to necessarily raise rates. We may be even pulling them back. And so we're pricing in future. We're always future looking. And so we say, I've priced in everything I know, and now I'm future looking and I'm going to price in a discount for what I don't know. And so that's what I see going on is that we're saying the euro's going to possibly raise rates because their inflations are going up. And so it's going to be higher demand for deposits. Remember, the currency market is driven a lot based off reserves and how much demand is for those currencies at 5.5, 6% versus something like the yen has zero still. So That's
Yeah.
the way I see it.
Geeks, but hey, you know what? On the way to the baseball game last night, we stopped by a record store. My son likes to collect records, and it's like left of the dial. I'm like, shoot, can I go in this place? No, but um, but I found a Roxy
Did you burn
Music
up
key at
on
the.
the threshold?
No, no, I didn't. There was. I'm not. Yeah. Anyway, but anyway, I found a Roxy Music the Atlantic years, printed in like 1983. So that's got to be cool, right? Roxy
That
Music is that considered cool? I don't know.
it Are we old enough that our stuff is cool yet? Um,
Well, it used to be. I remember GQ. This is like the later '90s. They said if you want to again seduce a woman, you play Roxy Music. I was like, was it still a thing? I don't know. But according to GQ back then, it was the music choice.
well then. No TD, no Don this AM. It's just us. You get us
Yes,
already for almost an hour, and now you get us for another album or another album. I just read in the
that's
chat,
right.
another hour. See, evidently you have agreement. Roxy Music wins. Roxy Music for the win. Don is in the air. In fact, he's still chatting with us. He's
Yes.
in the air, flying. He's streaming. Don is streaming us from 36,000 feet right now. That that makes us part of the Mile High Club.
Like so Don, when he goes to St. Croix, he has to make a stop in the Miami airport. I had a little experience at the Miami airport because we had our live event last November, which was amazing in Delray Beach. We're gonna have one this coming up, I think in September, maybe in Scottsdale. So if you want to hop on board, but the Miami Port Airport is interesting, But I was like, Don, we should live stream with you in the airport, just walking around, just talking to the people, and let's stream it live. And he didn't take it up. I
Yeah, we
wonder why.
tried. We
We
tried.
tried.
Grumpy says, guess that was my issue. No Roxy Music albums. So, Humble, I don't think we're going to refill the U.S. strategic oil reserves. I mean, that's not on the. I don't think that's on the docket. I don't think that's
I
a
mean,
plan.
they've done a little bit here and there, but I think at least one week they did. But yeah, I don't know. I mean, right now, I mean, like you said, it's an election year. I'm
Yeah,
like, there is an impetus to try to keep oil prices down and gas prices down, and again, it's hard to know what kind of influence can be wielded, but certainly they've already drained the Strategic Petroleum Reserve quite a bit already, and those salt caves are going to go bust if we don't start to fill them up soon. But
yeah,
this is
no kidding.
election year, so I don't think we're going to aggressively look to do that now. But I think it's interesting that if we look at the market, we're basically mildly up right now. The futures are up 0.09%, but gold is up more. And so
Well,
going
and
back to
this
weaker
is the
dollar,
ES
right?
5 minute. This 5 minutes traded flat. How often do we trade flat for the first entire 5 minutes?
Yeah.
And by the way, right at that monkey bar distribution, we broke out and we tested the 50, came back and we stopped right there. So where are the traders gone? Are they? Well, apparently they're in Miami, or in the air. They're in California driving on the empty highways. So
I would say
apparently
empty, but emptier than normal.
emptier. Yeah, and gold, gold, I don't know, that 5 minutes, the open we're just not doing
Yeah.
anything. What a dud of an open. What a dud.
I mean, certainly, I mean, certainly NVIDIA is one side of the story, but you look at Dell, for example. I mean, Dell's going to open up lower this morning, and or should I think, yeah, right?
So we
Not,
closed here,
yeah.
we're opening here, and
So I
we're
mean,
selling off. We're following through with the sell off.
yeah, I
So
mean,
yeah,
it hasn't
here, let me
exactly
go
been
to
all.
the daily so you can really get
I
it.
mean,
That
eh,
doesn't do it justice on the
there we
entry.
go.
That
That's the story we want to tell, Blake.
Yeah, sorry, I didn't
Um,
mean to get so myopic on that.
well, we're swinging from the monkey bars, so sometimes you don't see the drop, but that's a large decline in Dell. I mean, and really we've talked about this whole AI trade, but the reality is the benefits felt disproportionately. I mean, the server business, I mean, Dell finally saw an increase in revenue, and yet the server business that should help service AI has not been as robust. The margins haven't been as good. Um, certainly we have the prospect that companies are saying, oh, things are going to be amazing, like NVIDIA, but that guy's a hype monster, right? Just gets out there and just hypes everything. We raise guidance, et cetera. And, it's hard to really get a full read. I mean, not everything SMCI is kind of on that bearish side here as well. I mean, that was doing really well when, for a while earlier in the year. Um, Again, we're not seeing the breadth of strength in everything. I was looking at AMD yesterday. So on Thursdays, I do fundamental analysis and I try to disposition stocks as growth, value, or income. AMD does not pay a dividend, uh, and it's not a value stock. If you're paying, even taking into account not this year's but next year's revenues, you're paying 8 times sales for AMD. It's not a cheap stock unless we see even more significant growth expectations, like the 5-year projected earnings growth rates like 35%. And so these stocks aren't cheap, even looking forward 1 year or 2 years. And boy, I mean, a lot can happen over that period of time because these are highly cyclical companies. And when you start to price in that degree of growth going out 2 years on AMD and still be a price to sales of 8, it tells you that there's very high expectations despite the fact the stock dropped a lot, and is still not cheap. But it does have a nice growth outlook, but you're paying a lot for it. So as you look at some of these stocks in the technology space, it's probably more about renting them for the short term. You can construct oftentimes out of the money call spreads with a little bit of an edge because of the vol skew. But you're probably looking at limited upside in these names. Whereas you look at the other side, stocks like PayPal, I mean, those have been hammered, right? And the valuation is more attractive. But obviously, there's economic cyclicality, right, that could affect these companies too.
I'm just looking at the implied volatility on some of these because now that we're open, those are pretty inexpensive though.
Yeah.
They're in the bottom third as far as implied volatility. Let me link these up here so we can change faster. So you're liking PayPal, you're not liking PayPal.
Well, so a lot of times the stuff I talk about is related to option activity. So
Right.
so yesterday, and it was for next week's expiration, there was call buying at the 65 strike for the 7 June expiration. And so the idea is that you get a little bit of bullish option activity. And again, you see yields start to decline. Again, the market is okay. Sometimes you get a little bit of push. And
Is
so
that a $2
PayPal
wide
is,
spread there too?
yeah, $2 wide. Yeah, yeah. I like to stick about $2 wide. So oftentimes you might begin at 50 to 70 cents on a $2 wide call spread. 7 days a little short. I usually like to go out a little bit longer, like 30, 45 days.
Right.
But the idea is that in the very near term, there's probably some opportunity. But PayPal is also trading at a very low valuation. It's been beaten up. It's not necessarily, I mean, it could go lower from here. Again, it's a very cyclical business. But I was trying to say, hey, if we start to bottom here a little bit, we get a little bit of near-term balance. PayPal should participate in that. Was kind of the thesis yesterday, kind of laid out on the call side with PayPal. And so again, ITV is in a similar position, right? Oversold, coming off lows, yields start to pull back, interest rate sensitive stocks, bullish option activity. Sometimes you get a little bit of bounce in those names. But again, these are rallies you rent rather than own for the time being. And kind of the premise yesterday that I was taking was that a lot of people express that they are almost entirely in cash. And it's like, if you're all in cash, you're probably not worried about hedging. Okay. If you have a little bit of your equity portfolio is invested, you're probably not, you're probably looking to take you're probably looking to take some bullish opportunities because you don't have any risk anyway. You don't have any skin in the game. So we're kind of talking about some stuff in the near term that might present some near term bullish opportunities. AMD, PayPal, ITB were the three that we went over. Also Brazil, EWZ, PBR. There was some bullish option activity on Wednesday in PBR that we kind of talked about, but it's
So
got
putting
tied
in
to
a
oil
base.
and
Yeah, and PBR is
Petrobras.
I
Yeah.
speak Yeah, I speak Spanish. I don't speak Portuguese. So um I'm
So
not going to mess with the accent there, but um this this is getting bullish option activity. Are you thinking it fills the gap?
well, it was kind of the idea. So I know Johnny's been bullish on some stocks in the energy space like CV, MRO as well. Then it happened like MRO gapped up the next day, but So we were kind of looking at some of those names, looking at a spread opportunity on MRO, and looking at some other activity. And PBR is one of those that had some long call activity on Tuesday. And so, it's just one of those things that you're just trying to find where's the money going, right? And it doesn't mean it's going to be 100% correct, but sometimes when you start to get a little momentum, that positive feedback loop kind of kicks in. You can see them break. So PBR not quite as strong, but if the dollar backs off, energy prices hold. Usually emerging markets like in Brazil or like again, it's components like PBR, GGAL yesterday had some long call activity for December at the 45 strike. And that's a Brazilian finance company. So, again, weaker dollar. Generally, you look at foreign markets. We've previously talked a lot about like FXI in China, and I'm not sure that's necessarily fully played out. Weaker dollar, which should help Chinese stocks as well, but this scenario we're pretty bullish on for a while. But we got this pullback over the last couple of weeks as the dollar strengthened, and so if the dollar is going to weaken from here, looking at foreign, Chinese, Brazilian, those are two decent areas to look at from an emerging market perspective. If the dollar is going to weaken substantively here, remember, gold prices probably go up, beat the S&P 500 in that scenario as well.
I haven't looked at FXI for a little bit. This is an interesting one to me.
Yeah. So kind of we kick things off. FXI was one of the areas I was bullish on. It kind of started to
We're
flip a
not
little
quoting the
bit.
renminbi anymore. Dang it.
No,
We lost it.
I know.
I
I
hate
just look at
that.
the Aussie US dollar. It's not perfect,
Yeah.
but economically, the Australian economy has a lot of ties to.
Yeah. Australia and New Zealand are actually huge ties, as
Yeah,
especially from the energy and obviously gold and metals, as they
yeah.
ship all the raw basic materials over to China for production. Um, all right. Now we've had the open already. Obviously, the open was a little bit of a dud. But bonds are still on the rise. I think we're seeing that we're continuing that move higher. So does that mean we change from our bearish standpoint? Are we ready to go long housing? Are we ready to go long home builders? Is this continuation after the open enough to push us through the next level? Or what are you thinking as far as bonds go
You
from the
know,
short term, long term? What are
uh,
you thinking?
well, so again, my thought process is that look, we're 5.25, 5.5%. We're only going to go down so far. We're only going to go up so far in terms of yield, right?
Mhm.
So again, unless inflation rears its ugly head and we start to see some selling in the long-term Treasury bond note market, we start to see yield curve uninvert. But we're not there yet. So right now, again, we're playing it off of the outer bounds, and so yeah, I'm like, Now, looking to get long some interest rate sensitive areas is not a terrible thing. I mean, utilities on the week is the best performing sector. That's one way to get long playing this and more of a defensive play. If you want to get more aggressive, like an ITB works, a PayPal could probably work there. The problem with ITB is that I like the idea of buying out of the money call spreads just to keep the risk defined. And if it moves, you get the upside and you're taking a little bit of risk. Problem is that the volatility on ITB, if you bring up ITB and look at the option chain, go out to the let me just bring it up here on my side, but if you look out 30 days plus, let's just go out to the July expiration. The volatility, if you look at the call volatility is falling, and so what that means is when you trade spreads, you want to buy low, sell high, meaning you want to buy the low vol, you want to sell the high vol, whether it's calendars or verticals or some combination. And in this case, the volatility, you're going to have to buy a higher volatility on a spread to buy and sell the lower volatility by a call spread. So the pricing is just not great. Now you can get it to some of the individual components and the top
Just
weightings of
just
ITB, but
to draw people's eyes here,
yeah,
you can see it
right.
right over here. So
So you're going to have to buy the higher vol at 25 and sell the lower vol at 24. That makes the spread expensive and your risk and reward goes down. The break even doesn't change a ton, but it's a big deal on the risk reward side. If you can pay 50 cents versus 70 cents or 90 cents, I mean that again, you want to pay the lowest amount possible to amplify the returns. If you pay 50 cents on a $2 white spread, your max gain's a buck 50. right? You pay a dollar, your max gain's a dollar. It's a 1-to-1. So the risk and reward can really change. And so something I always like to look for is rising call volatility if you're going to play a vertical spread. And that's been pretty abundant, but not in all areas. And certainly for an ETF like this, it's not pricing that way. And it's pricing in the downside risk. So again, if you can't get it here, let the price rise and then look to go short again. Because when yields start to back off, start to rise, price starts to back off in the treasury market, it's going to reverse as well. So again, XLU is certainly one way to play the long side of falling yields, or going with TLT, just directionally, right, with the spread as well. But utilities coming off a low as well, so it's a more of a um, uh, it's pretty direct play, and it's a defensive play. And
Yeah.
utilities have outperformed since the week of. So I look at a 4-week rate of change, saying, okay, how's XLU performed relative to the S&P over a 4-week period? That changed the week of March 8th, and it has not looked back. So on a 4-week rate of change, it's still outperforming. And again, this last week, it's up 1.5%, including today's open. And technology is the worst performer at minus 1.69%.
Yeah, and to me, that's the rotation that I've been waiting for. And a lot of times you get utilities just kind of staying in a defined range, but this recovery off the lows, major sell off, higher highs, higher lows, we have wiped out a year worth of price patterns in that same time period that you're talking about. And so when we're looking at this move up in utilities, and I'm going to go back and kind of lean on what you were talking about as far as the implied volatility in the skews, even though Southern and Duke and Nextera are going up and potentially bull flagging on those first two, but a 52-week high, and I talked about this yesterday. And we talked about the implied volatility in the session yesterday. If you scroll down, not just at individual options, but look at this. Nextera through 52-week highs, and we still have a current IV of 81%. I would never think that a stock is going to be at near the top of its implied volatility. For those of you that don't know what this implied volatility percentage is, it's simply saying our 52-week high IV was 0.44, our 52-week low is 0.18, or in other words, 44 versus 18. And we are at the 81th percentile if you put 44.3% at the 100% level and the 18.6 at 0. We're somewhere here over the year. 81, the 81st percent. I was gonna say 81th. It's the 81th, Brandon. 81st percentile, and that means that's happening on the breakout. That's happening at record highs. Generally, volatility is high when we're falling, but we're extremely high in volatility on these utilities, and so we can get paid 3 ways till Sunday. We get to take a directional trade on it. We get to collect premium if you want to sell puts to get into the trade. You can, and also benefit from the dividend after you get assigned. So selling puts, I mean, the dividend is not great on Nextera, but Duke and Southern are better at closer to 4%. But 2.6% still nothing to sneeze at, as something that has climbed from its lows from 47 to 78, almost 100% return plus a 2% dividend.
Yeah, and when you go back to the lows last year, we did some fundamental analysis on Nextera, and it's a Florida-based utility company. It was one of the few bigger utilities companies that had a fairly high projected growth rate. Back then it was like 9%. It was almost best in the industry. So there's a lot of positives. Now, as we're getting on the other side of it, we're probably getting a little higher in valuation, but we're still seeing that rotation to the bond market. I know you were previously bullish on VST. On Tuesday, there was some long call activity at the July 110 on VST. And so again,
today's pulling back hard.
Yeah, it's pulling back, but the idea is it's just we're seeing that just steady drip. And when you look at the volatility in Nextera, 3,000 calls traded today, a few hundred puts. Part of the reason why you're having higher volatility is likely we're seeing a lot of call option buying, holding that up, playing the movement here. And so VST, again, July 110, but this pullback is a good thing if you're not in VST. So if we can hold up the next few days, like going into early next week, this could create a long opportunity. Yeah, maybe off that level you're pointing at there. So, it's not a bad thing to see pullbacks, especially if the volume is lighter. That's a good thing, right? It allows you to kind of re-enter these trends at a better price point with more short-term upside.
One of the questions that came through, and I'm going to shift back for half a second because I think it ties to utilities. And the reason why we're seeing utilities move, and that is, well, the question was, the European markets have been strong recently. Is that because of the weak dollar? The dollar's only been weak for 2 days. Generally speaking, your equities move opposite of your currency in the short term. And so if the dollar is getting weaker, U.S. equities have a tendency to go higher. The euro was weakening for 4 days, and the euro markets were going higher. And so generally, it's an opposite inverse correlation, because the currency that denominates that market, if its currency is weakening its purchasing power, then those have a tendency to mean that the stuff you're buying, which would be the Euronext and the DAX, would be going higher as the currency was weakening generally. Now, if you see an inflow of capital from outside into a country, that's when they will go in sync or go together. So the dollar weakens, the US equity markets generally go up. And that's all tied to this idea of what we're seeing in bonds and seeking a return on risk. And so the risk-free premiums would be the bonds generally, but we're seeing that in these utilities as a substitute for the risk-free premium. And at least that's the way I'm reading it. So it's kind of a combination of seeking a return, bond prices, currency's strength and weakness relative to those interest rates, and therefore weak currencies mean strong equity markets in those specific currencies. And we've seen that with the yen and the Nikkei. And do they still let us quote that? They keep changing things on us here with this whole rollover.
They're changing the symbols too, and
yeah, not a fan, not a fan.
it's EWJ.
Yeah, so, well, I've got the Nikkei up here, the Nikkei futures. Yeah, so generally speaking, if the yen is weak, we should expect the Nikkei to climb, at least proportionate to what we've seen historically on the intraday. Even if we're looking at this from the intraday view, and I were looking at the dollar index, and the dollar index, if the dollar sells off 0.25%, that's where we're at right now from the open. And this is the RTH, regular trading hours from the open, and we're talking about 0.25. I'm just going to round off of that. You can take that number and shove it. No, you can take that number and multiply it by 2.5, and that's usually what equities will do the opposite direction. And individual stocks about 5%. So there's a leverage effect that happens with currencies versus the underlying instrument. And this has been pretty dang consistent, both short-term, intraday, and long-term. So if we're looking at this and saying currently the dollar index from regular trading hour open, we're down 0.25%, we should see the 2.5 times this, which would be 62.62% up in equities, theoretically. Now, if we go over here and look at the SPY, because I'm trying to keep it to regular trading hours, we're only at 0.11. We're up, but not up enough yet. So that would seem to be leaning to that same kind of inverse correlation relationship. And again, I'm sticking to the regular trading hours.
And right now, the leading sectors are real estate, XLE, so energy, and healthcare. And again, energy has been kind of underperforming, but seeing recent strength. But again, a little bounce back there. But utilities, healthcare, not exactly the areas you look at for just looking at for confirmation of strength. Gold is up about where the S&P is right now. It's a little bit higher, but again, we're just kind of treading water. But real estate, the bounce we're seeing right now, again, this is one you probably look to take an opportunity as it starts to wane the near-term effect and look at getting short again. So we're just kind of consolidating. We're bouncing off the support the last couple of days. So we get towards, like say 38-ish. I mean, we probably look for this thing to roll back over again, because I just don't think
that's a lower high could be good for you.
Yeah. And so again, I think this is kind of an opportunity to kind of reload with a lower high with these, with like XLRE that's cyclical, but interest rate sensitive. Utilities is non-cyclical but interest rate sensitive, so you can kind of stay along there. Real estate's one for to look for that kind of near-term bounce. ITV as well, like near-term bounce, but then play the downside on the reversal. Staples not really holding up well. Mentioning of Costco in chat, that's down a bit today.
which is interesting because they beat.
Yeah,
So this was a safety play, protect, 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 protect. And we know that we're going to still buy at Costco. They beat expectations. Well, they beat analyst expectations.
yeah.
Um, did not beat last quarter, but beat analyst expectations. And we've liquidated it, pulled it back. It's because they sold all that gold. They had all that gold in their hands, and what they do, they sold it to you and I.
It's like it's like
It's
Darby
the
O'Gill and
chicken.
the
It's
little
the chicken
people.
bag.
I always do that damage on St. Patrick's Day. Darby O'Gill and the little people, that old Disney movie, The
Yep,
Leprechaun.
with Sean Connery.
Sean Connery.
Sean Connery is a very young person. Yeah,
Did Mike
yeah,
Myers.
yeah.
If you want my body, and just think I'm sexy.
Oh, Sean Connery.
uh,
There's only one Bond.
yeah,
All
he was the
right.
best.
So Costco is, I think it's going to be an opportunity to buy because we beat expectations. And we're going to continue to see some strength into, I think, into the safe plays. So Kroger, Costco, Walmart, I think are going to be able to maintain. And so Kroger's pulling back here. I'm going to be a buyer at 50. I think as soon as we get close to actually anywhere, any turn up in this gap from the previous earnings, this liquidation,
Hmm.
I think there's going to be a real opportunity here. I don't think I mean, it's not really catching a falling knife. It's trying to chase a rolling peeler, potato
Hmm.
peeler. You might still get nicked, but there's not a lot of risk to the way this is kind of slowly melting down. But I think Kroger and Walmart and Costco are all going to be opportunities. And this may be it. I mean, look at that low shadow there.
Hmm.
That could be it for me on Kroger, and we could be
Yeah.
looking at a bounce there.
But I think, since we're taking Don's hour here, I mean, one of the strategies that Don, has masterminds on, we have, a class on the TheoTrade site, is the
Mhm.
catapult. The idea that, you're selling premium, like for example, calls in the MES and buying call spreads elsewhere. I mean, Kroger, Costco, especially, I think, Don likes Costco chicken. Maybe he finds a bullish opportunity in Costco in this pullback, where if again, if the market's pushing and Costco's down, maybe Costco has a chance to outperform in the near term. We have in-out spread strategies as well. So oftentimes in these extreme selling conditions, it creates near-term opportunity where you just need a little bit of a bounce, and catapults, in-out spreads. Those are especially if the in-out spreads of the skews going for you a little bit. Um, they create opportunities, and you just need, for example, in Kroger, you just need what 50 days for it to go up a little bit.
Yeah.
And so those are the kind of plays that right now in a bigger selling environments can really work well. Don did a TLT spread that he closed out because you hit that profitability. Now we're reversing, going the other direction, right? And you just play the extremes, and you don't need a lot of movement.
So let's go through some of ours. And this we're gonna have. I want to make sure that we give enough time for symbols that people are interested in. Let's go through and make sure we've hit all of our setups that we're looking at. Um, I mean, we talked a little bit about Costco and CRM. We didn't hit Best Buy. I was going to look at Dollar General as a substitute,
Yeah.
but we've already talked about Nextera. And Southern. I didn't look at Duke. We've already talked about gold and PayPal and energy. Now energy. XLE is energy. Is Brandon's bullish? I'm bearish. Now I'm looking very specific to be bearish, not just energy. He's looking at the broad market. I'm looking specifically at these two, COP
Hmm.
and VLO. So I do the same thing on home builders. When we're looking at home builders, we have ITB, and you say, well, there's the bounce. And so great. So bounce,
Right.
what are you going to do? You're going to buy the strong ones, buy the ones that have the best ways to meet their obligations, and then sell the ones that are the dogs. So I actually have no problem with being bullish on part of them and bearish on the other part.
Hmm.
And so broad market, Brandon can be bullish XLE, well, I'm still bearish
And
ConocoPhillips and Valero.
and that bullishness on actually is contingent on the idea if you expect the dollar to be weak. And so again, I think with a lot of stuff that's in a holding pattern right now that are we're talking a whole sector in terms of energy, but I totally agree with the idea of being bearish via low because that crack spread, the difference between oil prices and gas prices are collapsing, right? So
Mhm.
so that places
No
pressure on
margins.
VLO, no margins because they're a
Yep.
buyer of oil. XLE, the biggest components are like Exxon, Chevron, and so sometimes going to the producer level, if we're looking at oil prices rising, with oil and backwardation, USO is one that's probably outperformed oil. But again, it needs what? Oil prices to rise. And so again, the dollar is going to play a major factor here in where commodity prices go. So again, I think it's all right to take a bullish trade in XLE or other energy producing names, looking at some near term strength on a weaker dollar. But if you don't think the dollar is going to weaken, then you're probably holding off there, and you're probably going the way Blake's looking, right? And
Yeah,
looking at
and
VLO.
from a base fundamental standpoint, if I pull oil out of the ground, I get $77 a barrel. That's it. I mean, let's keep it simple. If I'm pulling it out of the ground, I get $77 a barrel. And most producers, if it's over $45, they're making margin. Okay. But Valero doesn't pull oil out of the ground. They're buying it at $77 a barrel.
Yeah.
So that's the difference. The people that can produce it for, we'll just say $50, they've got a $27 margin in there. Valero, if they're retailing it and refining it, they have to pay all that margin. That's really the difference.
Yeah.
I always like to use the Starbucks as the example because it's just a simple concept. Starbucks charges you a lot. They charge you $10 a cup, or 12 or 15 for a choco mocha latte, whatever. But the fact is, if coffee prices go up, they're not going to crank up their $10 again. And so when coffee prices are rising, their margins are going down. If coffee
Mhm.
prices are falling, their margins are going up. That's Valero. Starbucks is the Valero of coffee. They taste like gasoline. Anyway,
It's the same color, I guess. I don't know.
it's just tar. It's just tar, oil, crude oil. So it's just a margin game. So yeah, Valero, anyone that has to buy it and aren't producing it, even holding at these prices still mean their margins are being pinched. And then if they have low demand on the retail gas side because there's less travel, they're paid the higher prices for oil and they're not getting the demand on selling their product at the higher price. So
Yeah.
that's the way I see it.
And Blake, I love the Moulin Rouge reference, mocha chocolate. Yeah, yeah.
See, you and I live in economics and in movie quotes. Um, that's just what we do. That's just what we
And
do.
music lyrics.
And music lyrics. That's right. I do that in the futures class quite a bit. As I quote music lyrics and see if people can figure out where it's coming from. Um, Eric says, "I'm surprised you don't believe in filling the gap." Eric, filling the gap to me is the same idea that 1,000 monkeys could type the entire work of William Shakespeare if given enough time. Every gap fills if given enough time. I
Yeah.
don't think it has to fill it. I
Not sure.
don't. It's just
And
I'm not a
that
buyer of them.
is one that has written a lot of questions for the CMT exam. It is one of the myths that all gaps fill. But you're right. I mean, over long enough time frame, right? But how do you trade that? That's the problem. But again, the idea is that when you see significant levels break, right? So if you see the low break on an upward gap, that is a reasonable trade, right? Looking for that gap to fill. So there's times where you look for gaps to fill, but like that Kroger trade, yeah, I mean, we start to break the low of the last few days. You're probably looking at that gap filling and rolling back, but
Yeah. Well, and
or we
I'd say,
gap from here, we get an island reversal.
how big does the gap have to be for you to expect it to fill? There's a gap back here,
Right.
and officially there's a gap here. Does it have to actually get to the price because it missed it there? And so gaps filling, yeah, small gaps they can fill there, but the fact is, I see this as a little bit different as well. There was overnight activity here.
Mm-hmm.
Gaps are nothing more than not representing what happened in the overnight. So we started here, tested here. To me, that is testing where the
Right.
sellers couldn't push it back down. And so that low shadow is where we're at. And that is, the buyers pushed it up all night. The sellers tried sometime after the open and could not get it past this point. So to me, that's the sellers unable to break that point, and we're at that level again. So I'm not saying jump into it. I'm saying analyze it
Yeah. So
and
Michael's saying
determine whether this is a good price.
it's not 80% gaps fill 80% of the time. Again, I think you have to assign a time frame for that, right? Because again, what's tradable? But that's a very significant gap that we received in March. So again, all gaps fill is a myth within technical analysis, right? But you can say, well, yeah, but a gap filled 2 years down the road. Again, how does that affect you trading wise? Right here, though, you have a gap that should establish a level of support. And we had a very large bodied candle that finished here at the high of the session. And so again, that low is very significant. And so whether or not, it's going to break or not, it does create a level that is significant. And when I say significant, that means that you can create your exit around that low. So you can say, look, if I break this low, it's significant. The gap should fill. I should probably get out. So that's the good thing about these levels is that whether you infer the price is going to hold or not, can understand that that level is very significant on that day, on a very wide ranging day, and with massive volume. And so all of us things say, look, if that low is broken, okay, now I know it didn't hold, right? So a lot of times we're using these gaps and other things as just levels to establish a trade and establish risk and reward, and you can create your exit around that low of that gap day there because it was very significant in that moment and has a level of significance going forward. So again, if you say, oh, well, all gaps fill, then you're not going to take this trade because you're saying it's going to break through. But and yet, from a technical analysis perspective, using the body of knowledge of technical analysis, that level is very significant, and this can create a setup for a trade and just getting out if that level's broken. So if it turns out it fills, boom, you're done, you're out. But if
And I'll just
not,
say, you also have a pretty low risk trade to even sell puts here because
yeah.
they're getting paid a lot.
And higher implied volatility means you can sell further out of the money compared to the past.
Yep.
And that's and potentially get a little bit better premium sometimes too.
Yeah, even just the next 3 weeks, they're going to pay $1.50 on a $5 stock. What is that? 3%?
Yeah.
3% for 3 weeks at the money, or go out lower. So, all right. Do you want to look at is there anything else you want to look at on the ITB or
No,
IOI or AGNC before we
yeah.
open
So
up the
ITB, so I'm kind of near term bullish here just because the option activity, falling yields. But the issue with the implied volatility is that it's hard to establish a long trade with defined risks. So look for the bounce to happen and then look for the short opportunity. Same with jets, same with real estate. It's the opportunity to start to get bearish may materialize in the next few days. So bullish right now, but these should turn into bearish opportunities. And with the way the volatility is structured, it's actually easier to go bearish on these than go bullish off of the highs.
how about your IYR's behavior right now?
Same scenario, right? So
Mhm.
it's hard to get long here unless you're going to buy stock, right? Buying it again, I like to do vertical spreads. The volatility makes it hard to go long in the near term. So wait for the move to happen as yields start to back up, start to rise again. Then you start to look at setting up a bearish trade in some of these areas. And it's kind of the same scenario we talked about a couple weeks ago when we're kind of getting towards highs. We got the rip down, right? So now we're getting the bounce back up again. Look for that next rip down is the idea. So Blake's typing in, what do you want to look at? So again, if you
Yes.
have symbols you'd like to review, we got about 20 minutes for us to be able to review some of those and talk about it. AGNC, same scenario here, right? This is lower price than if you could probably even just buy a put. but look for that bounce and near term high, key off of interest rates. So near term bullish, but setting up in the next week or week and a half, hopefully for a bearish opportunity on AGNC. But that turn may come quickly if yields start to rise. Dimitri says, comment on Chicago PMI. Do you have anything you want to say on that, Blake?
You know what? Sure. Chicago PMI, we used to be a lot more dependent on Purchasing Managers Index, especially the manufacturing data, than we have been over the last decade. There's been a major shift, and we've done this in the U.S.'s history quite a bit. We've had these things that we've shifted away from. So we were a manufacturing country. We still are a manufacturing country, but primarily in areas that we aren't manufacturing physical goods. I mean, we're still considered a manufacturing country because we do software and tech. But reality is, PMI, Chicago's PMI has not had nearly the impact and the influence that we've had in the past. And so the fact that it is terrible, I mean, horrendous. It's one of the lowest levels. In fact, it's the lowest level we've had since outside of 2020. In over a decade. So it's not good. It's showing us that manufacturing is dead. And I do think it's an indication that the economy is slowing overall. Again, the issue I have with it is the number just doesn't have the impact to us as far as trading goes, but it is a bad number. It is horrendous. In fact, let me just grab this over here. There you go. So you look at this number, anything below 50 is considered an economic contraction in manufacturing. And so the Chicago PMI fell down to 35.4, major miss, downtrend, downtrend, downtrend. We had the 2020 lockdowns that did this. Otherwise, we have to go, it's worse than what we've had before the recession in 2008. So we just haven't had the impact from it. But if I were looking at this purely from an economic standpoint, we should be scared. We should be running for the borders. We should be buying long puts if we were just purely going off of manufacturing data, because it's worse than the last recession, worse than the lockdowns.
Well, if economic data mattered, I mean, if we're looking at kind of the leading economic indicators index, I mean, it has not been great either, So the reality is we're kind of at a point where everything's keying off the Fed, and it's disappointing that that's the case. We don't care about savings. We don't care. We all care about spending and debt. So as a result, we're just shrugging this stuff off. If it's bad, it can be good because it means the Fed's more likely to cut, that inflation is not as much of an issue. And so there's this kind of logic that, again, it doesn't matter what the real economy is doing. It just matters that can prices go up. If you look at earnings we've almost had the entire S&P 500 announced, 78% are beating earnings estimates, 60% on revenue. Those are, on the earnings side, a little bit above trend. Revenue is a little bit less than trend. But the Magnificent Seven has 50, I think it was 55% earnings growth. And we had 51% earnings growth, 14% revenue growth. So everything is just keying off a handful of companies from an earnings standpoint. The earnings last quarter, year over year, is better than last year, but a lot of it's hinging on those Magnificent Seven stocks, earnings and revenue growth. And so nothing else matters, right? It's like we're Metallica's song, and nothing else matters. And so that, to Blake's point, that's probably not going to be as impactful. Mario says Costco pre-COVID 309, 0% interest, earnings $220 to $300-ish. Now $790, 5% interest, earnings the same. So again, we're not seeing the growth, right?
Yeah, well, and that number is this, like I said, this should scare us.
Yeah.
Anytime we've gone negative, and people avoid paying attention. 2015, we actually had a 30% pullback in the Russell. People don't look at that and remember that we had a major we had a bearish market here.
Yeah, it was.
Yeah, had a mini bear market here. No one talks about it. But here, these are recessions, flat out recessions. But we don't care.
Yeah. And Dave's talking about JWN. John W. Nordstrom misses by 3x, common holding up. Yeah. So I mean, this is the point. If you're banking on the consumer, right, spending, I mean, again, just look at Walmart and Target. Look at Gap and Kohl's, right? It's a 50-50 bet that there's going to be some movement. And the downside of missing is way more significant than the upside of beating, with the exception of very high short interest stocks, of which Nordstrom's oftentimes does have very high short interest. And so the idea is that with these companies, they just kind of push your narrative to short. So JWN, Lulu was a
Sorry, I'm
disappointment. They got
yeah.
upgraded to 500 price target yesterday. I think it was professors commenting on that, disappointed. And the but Nordstrom, again, they're high. I think I haven't looked at it recently, but not too long ago, they had a fair amount of short interest. So sometimes these stocks get buoyed up in the near term. And but if they miss, just take that as a key. There's a three-prong approach to buying stocks on earnings: a beat on earnings and revenues, stock price going up, and positive guidance. If you don't got those three, you don't have those three, I guess use proper grammar. Um, you really don't have a lot, right? I mean, you
Yeah.
got to see that kind of three-prong effect. Yeah, but we got
I
a
mean, it's
jobs report next week too.
react, respond, and look forward to the future. I mean, it's just a three-pronged effect.
Yep. So Apple, I mean, Apple's had a nice rally here, and we got news they're increasing their shipments to China, but I thought it was produced in China. Do you have to ship it? But anyway, point being is China
Yeah.
sales may be up, but
They
it
put
didn't
the
really.
sticker on here. They put the
That's
safety
right.
sticker on the box here.
That's right. And so, look, it didn't get a lot of lift. This was the
Nope.
other day, and we kind of popped up to that resistance and fell back.
Well, isn't it
And
that
so,
they keep shipping the phones there, but the consumers aren't buying them?
yeah. So, is it a channel stuffing scenario where they've done it in the past?
Yes, they have.
Just said they sent all this stuff, Caterpillar as well, send it to China. I mean, I was reading a tweet from a guy that's in the auto space talking about channel stuffing on for automobile producers, auto
Mhm.
producers, manufacturers. Their channel stuffing. So there's probably going to be a lot of need right now to make their earnings look better, and it's called stuffing channels. And you're going to feel the effect at some point here. So it didn't really buy the news to me as we're approaching resistance here in Apple. That's a problem. Stuff
Yeah.
like Google.
I, I'm sorry, I was gonna point up
Go ahead,
DXCM as one that was.
Dexcom.
Yep. I'll go back to Google for you, but
Yeah.
uh,
But I think
and
there's
then
better
we'll.
opportunities if you're looking at technology. Google might be one of those. Don walked through a catapult on Google
Do you prefer
the
the
other day.
A or the C?
Uh, let's see, Google. Sorry, the A with the voting rights.
Okay, I just want to make sure.
Google,
Alphabet
but
L.
yeah. So Don walked through a catapult on this one where you sell calls in the MES to finance a long call vertical on Google L. And hey, if Google takes off, great. After calls, you have a risk-free trade in Google. And
Yeah.
so this is, again, looking at Google, probably a little more bullish near term than, let's say, for example, in Apple, just given this week's reaction to some of the issues they've had getting back towards highs.
By the way, Google's one of the greatest examples of gaps not filling. And
Yeah.
again, given it when you say gap fills, how much time? You have to define that because otherwise, does this count as a gap fill 3 months later?
Yeah.
Otherwise, if it's within a week, a month, this gap didn't fill, 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 this gap didn't fill. This
Yeah.
one probably won't yet.
Yeah. And the thing about this is that, again, it's like technical analysis does not predict the future, right? We're just looking for repeatable patterns, and we're looking for areas where there was accumulation and distribution. So when you
Yep.
have gaps, it's a sudden area of accumulation or distribution, being with the gaps up or gaps down, where they're agreeing upon a price.
Yeah.
And
Think of that
so,
as a really big red candle.
yeah. And so the idea is that when you get these levels where they agree upon price, it just establishes significance at that level that if it's broken, okay, look, if I own stock, or short stock, I probably want to get out, right? You can structure your exits around them, which is an important part of trading.
Right. Yep.
You can measure
Uh,
risk and reward off it.
let's go back to DXCM. And I don't know. I actually have never looked at this. I haven't
This
traded
was
it. I have
a
no opinion as far as fundamentals go. I'm just looking at the chart. You have any
yeah.
comments?
I haven't looked at the stock for years, but I believe it is a medical device company. So this was one of my on my COVID list way back when. What we can look at from a technical standpoint, right? We had a major breakout yesterday on significant volume. We broke that level of support you're seeing there. And so what are we looking for? We're looking for a continuation in the downtrend. Now, the next level of support is going to be down around that kind of 113 area based on those prior lows. And there's kind of a vacuum. There's kind of a space below that. So if you're looking to get long, you're probably looking at that area to see if we can hold up. But yesterday was a significant breakout. You could probably even buy like a 116, 114 long put vertical spread, and we retest lows. You could probably, probably get out for a 60, 70% gain.
Yeah, and I would say this is probably a dead cat bounce off that
Yeah,
gap up, and probably get, like you said, you're probably going to go back to 113.
yeah,
But
and
113 again, there's the accumulation distribution, just a ton of accumulation right here.
yeah,
That's a great place to take profit on a downward move.
yeah.
Not
So
necessarily
long,
buy it just cause, just
yeah.
protect.
And those long put verticals, if you're buying the lower vol at the higher strike, selling the higher vol at the lower strike, $2 wide, that's again, we haven't seen the strike select, but again, the idea is that that's a pretty reasonable setup for a play
Yep.
back down to lows. And if you give yourself, 30, 45 days, you could bounce up and then break down. So still got time there.
Yeah. Is it a cup and handle off of the weekly charts? If this is the symbol, Gene, I'm not seeing it.
Yeah.
Unless you're talking about way back here. If you're
Well,
talking about this, it could have been. I'm
yeah, no, there's no handle in that case.
it's
So yeah.
Gene, this is a very special pattern called the ladle.
Right. So what you do have, so again, if we're talking about that time frame, we've already blown through any target you would get from that. If you're going back years, then we're not even testing the high, right? When it probably had its IPO. But what you do have here developing is a potential bull flag, right? We have a nice run, straight line move higher. I don't like the gap in there, but again, you just even taking from 2250 up to the high of around 29. I mean, that's a $6.50 move. So volume's been lighter on this pullback here. So if we don't go below 25 and we catch a bid kind of breaking out of that, you see a bump in volume, you could look for a move about a 650 move off of that. At least even just near term retest in the prior high at around 29. But you might get a bigger move out of that if we eventually break out on volume.
And for those
Just
that maybe haven't traded flags before, I've seen people trade flags on 2 candles. I've seen them go longer. Pring tells you that you can go up to 4 weeks. But I think the key here is you don't want it to fly past half mast.
mhm.
And so if it closes past the 50% of the run, and I am tell me if I'm doing the measurement like you're
Yeah,
saying here, Brandon, from the gap to the high, if it goes through half of that, abandon it as a flag pattern. It'll set up something else for you. But
yeah,
the idea is if it breaks out anytime before here, then it should replicate that 23 to 28. You can see a $5 move. So if it broke out through today's high, you could be looking at 31.
yeah. So again, that breakout's kind of key. Where it holds up, like Blake said, it just if it starts to pull bleeds too low, or it's just gonna, you might look for a retest the prior high, maybe. This stock is, it's an extremely volatile stock, and so when we talk about technical analysis and charts, it's harder to apply on a stock like this that gaps a lot, that has big moves, that has this big mispricing at times. And
Mhm.
so again, it's just not going to be as easy to assess, probably fundamentals or technicals on a stock like this because it is fairly erratic and highly volatile. Traditional forms of technical analysis work on more stable stocks where, it's more of a known in that context.
Well, if we can, I'm going to try to combine a bunch of this really, really fast because we're down to 3 minutes here. Um,
Oh man, that
And
went fast.
yeah, yes, it did. In conjunction with what we're seeing happen in the market. So I'm going to go back to that dollar index really quickly and just point out something that's happening in this morning's move. We sold off, sold off, sold off, sold off, sold off. We're back at the floor. If the dollar defends here and bounces up, that means dollar purchasing power goes up, and theoretically equities are going to put in a top. Theoretically, if we break it, then we're going to continue to slide lower. But if you look at this in conjunction with what has lifted the market, like you're talking about, what is NVIDIA doing? Is down 1%. What's lifted the market? It's right where? At support, at
Yeah.
support, at the barrier. If it breaks through that barrier, then what are we seeing? We probably see this replicate again, which is 40 points to the downside. If it bounces, great. If it doesn't, liquidate. But if Apple's what lifts everything, then are we going to see Amazon and Apple and Meta, are they going to be able to bounce? If it's all about AI,
Yeah.
where are we at? Through the lows, Amazon's dead.
Yeah. Technology is the worst performer right now today.
Yeah.
And it's the worst performer in the last week. It's one of the better performers in the last 3 weeks. But this last week, again, despite Nvidia's blowout earnings and the major move Nvidia, does not lift the technology broadly in the last week or today. It's helping drag it down.
Yeah, and so this is the S&P with all the different sector ETFs. This is XLK. Technology is down 2% since yesterday's open. While who's our top performer? Real estate. There's your
Yeah.
bond move, and healthcare, defensive play, and utilities. So everything we talked about, defensive play, real estate on the interest rate, but tech is just being completely obliterated comparatively.
Yeah. And the utilities has been the leader in terms of sectors going back for a while. And again, it's significantly outperformed with very little downside moves in the interim since the beginning of March. And so again, we can talk about the bullishness of the market, but we're seeing defensive rotations. And so again, it's hard to kind of jive, and you kind of understand the idea. Well, why is the market struggling? That's good reason, right? We're seeing rotation.
And maybe we're finally seeing that fundamental play out with Chicago PMI and everything else. Everything is not awesome, unlike the Lego song that it says.
That's right.
So Brandon, we're going to be wrapping it up here. The professor is going to be coming on, and he's going to be doing part 2 of his Risky Business, a crash course on applied portfolio management. And it's good time to be managing. It's good time to be careful, my friends. It is an interesting day, an interesting week. Brandon, any parting shots, comments, thoughts?
I want to know if the professor is going to slide in with his button-up shirt, Risky Business.
Oh,
I don't want to see it, but I'm wondering if what's going to happen.
just
What's going to
tell me if you
happen?
did. He's got
The
his
algorithm
Ray-Bans.
made me do it. No, I'm joking.
He's got his Ray-Bans on, his white button-up shirt, and long socks.
Yeah, but I think the 23rd is that range on the low, the high. Again, those are key levels to watch. So if we fail here at the lows from the 23rd, we roll over today. Again, we're probably going to continue lower, and I think the option market's definitely been kind of pointing to the risk to the downside. So, Professor, you got the right shirt
He
on.
does have the right shirt on. And the
Yes.
question
Did
is,
you
does he have
slide in
pants
Risky
on?
Business? We're talking about.
Brandon, you got to announce the program today. What's my coaching session today?
Well,
Blake
that's why
already
we said
did.
it.
Risky
That's why we
Business.
said it.
Risky
Business.
business.
You're wearing the white shirt, like from Risky Business. You're going to slide in with your Ray-Bans and sing a little old-time rock and roll.
I wore the shirt because it's bringing out the professor in me. It's not because of risky business, but you know what? Come to think of it, that's really a good point. I never thought about it. So,
but you're counting the money though.
I'm counting the money today. I'm having a good day. Short side, yes.
That's right.
All right. Well, we're going to give control over to you, Professor, and we're going to go. I'm going to jump over to the futures room, and you'll see Brandon and I back later on today, but we'll hand it off